Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I'll be taking you through how we adjust non-controlling interest in the consolidated profit or loss and OCI. Now let's look at this question. Again, we start with the requirement. So the requirement, what is the total comprehensive income attributable to NCI at 30th June 20x8? That's the year end. Now, the details of the question. Willie co-acquired 80%, so it means that 20% NCI of Koyet on 1st January x8. Again, reconcile this to the year end. The year end is 30th June. This will give us 6 months since acquisition. And it's important you track these dates. If not, you get the answer wrong. Now, at the date for acquisition, Koyot had a building with a fair value of 22 and a current amount of 20. The remaining useful life of the building was 20 years. So here, the fair value adjustment would be 22 minus 20, and that should give us 2. Then we can look at the fair value depreciation. Now, Koyot's profit for the year ended was 1.6, which accrued evenly throughout the year. Now, Willie measures non-controlling interest at fair value. Now, at 30th June x8, it is estimated that goodwill in Koyot was impaired. So once they use fair value, NCI will share in their impairment. So as a pro forma, all we need to do is to say if our non-controlling interest in the consolidated profit or loss on OCI, it is almost the same as the non-controlling interest in the consolidated financial position, except that for the P&L, we do not account for the NCI at acquisition. So we start with the share of profit. So from the question, let's see, the profit made for the year was 1.6 million. So let's say this is in million. So 1.6 times, remember, it's time apportionment. So times 6/12. Then times 20%. So let's see, 1.6 times 6 divided by 12 times 0.2. And that should give us 0.16. Now we take their share of fair value depreciation. So you go up there, and the fair value adjustment was 2, and depreciation should be based on 20 years. So it is going to be 2 million over 20 times the time apportionment times 20%. So 2 divided by 20 times 6 divided by 12 times 0.2. That gives us 0.01. Remember, this is a deduction. Then we take their share of impairment, and because we measure them at fair value, let's see, the impairment was 500, and that is 0.5. So 0.5 times 20%. So 0.5 times 0.2, that gives us 0.1, and it's also a deduction. And please note that the impairment is a post-acquisition transaction or a post-acquisition adjustment. So you do not time apportion. You only share between the parent and the subsidiary, the non-controlling interest. You share between the parent and the non-controlling interest. Great. So just to see if I've taken all the issues, so I've dealt with the fair value, I've dealt with the profit, I've dealt with the impairment. So now let's close this for the adjustment. So I have 0.16 minus 0.01 minus 0.1. That gives me 0.05, and this is in million. 0.05 in million should be in thousands, should be 50,000. Should be 50,000. So it's important you master rounding between million and thousands. Very important to be able to adjust this in the exam. If not, you get the figures wrong. So from the option, let's see, this will give us option B as the answer. I hope this helps you in your preparation for the FI exam. Please subscribe to this channel to receive updates on new videos.